I meet with about 20 new high-earning W-2 employees every week. They all earn over $500,000 and they all have the same questions and concerns. How do I lower my tax bill, and how do I make sure I'm on the correct path to building long-term wealth? Well, if you find yourself in this situation, this video will give you 5 ideas that you can take and implement within your financial plan today to help you reduce your tax bill, as well as make sure you're on the path to building long-term wealth. If we haven't met yet, my name is Ryan Knoll, and I'm the founder of NAV Wealth Partners, a financial planning firm that helps clients across the United States maximize their financial picture. The first step and the easiest thing you can do as a W-2 employee to lower your lifetime tax bill and set yourself up in a strong financial position is to make sure that you're maxing out your retirement accounts at work. For 401ks, 403bs, and 457 plans, there's an employee contribution limit of $23,500 for 2025. There's a catch-up provision allowed for individuals aged 50 and older where they can defer an extra $7,500 into that account for that year. And there's a special catch-up contribution privilege allowed for individuals between the ages of 60 and 63 of $11,250, which essentially allows you to defer paying taxes on $34,750 worth of the contributions. Those of you in the 35% tax bracket, that's tax savings of about $10,000 right there. The next thing you could be doing in order to lower your lifetime tax bill, and assuming you're not covered by a retirement plan at work, is to contribute to a traditional IRA. The contribution limit for 2025 is $7,000. And for those of you over the age of 50, there's an extra $1,000 allotted, or an $8,000 contribution to that traditional IRA allowed in any given year. If you are covered by a retirement plan and you do have income above a certain limitation, that will not be a deductible contribution for you. But what you can do to lower your lifetime tax bill is still make that non-deductible contribution to the traditional IRA, immediately convert it to Roth dollars with no tax implications, let that money continue to grow in that Roth IRA tax shelter, and then it would essentially be distributed to you in retirement tax-free. Another account that you should be taking advantage of at work is the health savings account. For individuals on a high deductible health plan who have access to an HSA, you can defer an additional $4,150 a year to the plan, which is a dollar for dollar reduction in income that you have for that year. And if you're on a family plan, you can contribute $8,300. There's a special catch-up contribution for individuals age 55 and older of $1,000. Those contributions, again, are tax deductible, and as long as you use those withdrawals for qualified medical expenses, they're tax-free, regardless of your age. The cousin to the health savings account is a flexible spending account, which you can contribute $3,050 to in 2025. And married filing jointly, you can do about $5,000. Contributions will reduce your taxable income just as they would in the HSA, and they can be used for qualified medical and dependent care expenses. But the one thing to be cognizant of here is that if you don't use all of the contribution in 1 year, you're only allowed to roll over a specified amount to the following year in most plans. And any money that's still left over will be returned to you and basically added to your taxable income. All right, moving on to the second way we can help plan for your future and drive down current taxes while maximizing your overall wealth is exploring the 529 plan. A 529 plan is a state-sponsored tax-advantaged savings account designed specifically for education-related expenses. It's a powerful tool for reducing tax liability while saving for educational goals. And here's a breakdown of how it works. Some of the key benefits of a 529 plan are tax-free growth, so contributions grow tax-free and withdrawals are also tax-free when used for a qualified education expense. Some of those qualified expenses are things like tuition, fees, books, supplies, computers, and even room and board for higher education. Some states even allow funds to be used for K through 12 tuition up to $10,000 annually, or student loan repayment subject to that same $10,000 lifetime limit. There's also estate planning benefits. Contributions to a 529 plan are considered completed gifts for tax purposes. So those of you who are tracking to have a larger estate, this can reduce your taxable estate at the time of your death. As far as contribution limits to the 529, there's no annual federal contribution limit. And while there is no federal contribution limit, there is an impact to the gift tax. So for 2025, you can give $18,000 to an individual per year, and that money will be excluded from your taxable estate without you having to file any additional paperwork that could potentially attach to your taxable estate at death. So for married couples, you can essentially give one child $36,000 a year. It can be looked at as a completed gift, and there would be no additional paperwork that you would have to file that could come back and be tacked onto your estate at the time of your death. There's also the 5-year super funding rule that parents or just anybody in general can give up to 5 years worth of contributions in a single year. So parents this year in 2025, if you're a single parent, you give $90,000 in 1 year to a child's 529 plan. Or if you are married filing jointly, you can do $180,000, and that's a completed gift not subject to gift tax rules. There's also state tax benefits when you're contributing to a 529 plan. So many states, not all, but many states will offer income tax deductions or credits for contributions to their state 529 plan. So you want to check out your state's specific rules. An example of this is some states will allow a full deduction for contributions, and others may cap deductions or provide percentage-based credits depending on the amount of money that you put in. Another relatively new rule is the portability of 529 plans, and all that means is that you can switch the beneficiary to another family member, so a sibling, a child, a grandchild, or even to yourself without penalty if the original beneficiary doesn't use all of the funds. One of the most significant developments in the 529 plans is state parity, where states allow you to claim a tax deduction or credit for contributions made to any 529 plan, not just your home state's plan. This increases flexibility because it allows you the opportunity to shop for the lowest cost plan and being cognizant of all the investment options that you have to maximize the value that you get out of a 529 plan. Now, not all states are considered full parity states. A full parity state, an example of that would be like Arizona or Pennsylvania, and they provide equal tax benefits regardless of which state's 529 plan you use. And then there's also limited parity states. So an example of this would be like New York or California, where you have to use the in-state plan in order to be able to utilize the tax deduction benefits upfront for those contributions. In an instance where clients don't use all of their funds in the 529, whether they got a scholarship, didn't need them, or their total cost of their tuition, room and board and all that good stuff didn't end up completely depleting their 529 plan, there's actually a new rule as of last year where you can fund a Roth IRA up to $35,000 for the beneficiary of that 529 plan. So the way that works is you're subject to the annual contribution limit, which again this year is $7,000. But essentially you can make a $7,000 contribution for the next 5 years, get $35,000 into that account for that individual, and that money can grow for them for retirement. So just to give you some food for thought, the average 18-year-old, if you started funding a 529 plan for them to be funneled into a Roth IRA, $7,000 a year for the next 5 years, maxing out that $35,000 limit. Somebody who's 18 now, by the time they're getting ready to retire at age 60, would have pretty darn near close to $1 million in that account. And again, that money's all tax-free to them in retirement. So while it might not help you tax-wise right now, it could help someone you care about later on down the line by utilizing the 529 plan appropriately. The third step high-earning W-2 employees should take to ensure they're maxing out all the benefits available to them inside of their workplace plan. Oftentimes, there are hidden savings of thousands of dollars annually if you know where to look. Some of these examples are things like commuter benefits. So what's a commuter benefit? Some employers offer commuter benefit programs that allow you to pay for eligible commuting expenses like public transit or parking with pre-tax dollars. The tax benefits of this are contributions to commuter accounts are not subject to federal income tax, Social Security, or Medicare taxes. The monthly pre-contribution limit for 2025 is $300 a month for transit expenses and another $300 for parking expenses as well. So, for example, if you contribute the full $300 per month to a commuter account, you could save roughly $1,080 in taxes annually, and that's just based on having a combined 30% tax rate. Something else you should take advantage of is tuition reimbursement. So many employers will offer tuition assistance programs to help employees pay for continuing education. Under 2025 tax rules, up to $5,250 in tuition reimbursement per year is tax-free. If the reimbursement exceeds this limit, the excess amount is considered taxable. Advantage of this is you can advance your career without incurring additional out-of-pocket costs or tax liability. Something else you could be taking advantage of is the dependent care assistance programs. So some employers will provide dependent care FSAs, like we talked about a few minutes ago, that allow you to set aside pre-tax dollars for eligible child care or dependent care expenses. You can contribute up to $5,000 per year if you're married, or $2,500 per year if you're married filing separately. Contributions reduce your taxable income, which lowers federal, state, and payroll taxes. And then as far as taxability of those funds go, as long as they're used for a qualified education expense, there's no tax liability for those funds. If you receive a dependent care credit, the amount of the credit may be reduced by any amounts contributed to the FSA, so that is something to be aware of. And the final thing you should be taking advantage of inside of your retirement plan, if it makes sense, is employee stock purchase plans. So some employers will offer these employer stock purchase plans, or an ESPP, that allows you to buy company stock at a discount. The taxability of this is the discount itself may not be taxable until you sell the stock. So if you hold the stock for a specified period of time, usually 1 year after the purchase or 2 years after the grant date, you may qualify for more favorable capital gains treatment. So it's a good way to get an upfront discount on a stock that you might feel is undervalued or that you feel has good growth prospects. and then allowing that to grow for a year or two, so you're subject to the capital gains rules as opposed to the ordinary income tax rules, can help you save money in the long run by paying a lower tax rate on something that you essentially bought at cheaper than what its market value was. Oftentimes when I'm working with high W-2 income individuals, I find that they've already done the first 3 steps, but then I find out that they're contributing to a regular brokerage account. And this account may be subject to large gains because they've picked some good underlying securities that have appreciated in value, whether they're ETF, stocks, bonds, and mutual funds. But the thing is, they're not proactively managing these gains or thinking about them in a tax-efficient manner. And this is where our 4th strategy, tax loss harvesting, comes into play. And tax loss harvesting is a strategy that allows you to reduce your tax liability by offsetting investment gains with investment losses. So let's go through a detailed explanation of how it works. So first things first is you want to identify losses. And losses are just when you sell investments, stocks, bonds, mutual funds, ETFs that have decreased in value since you purchased them. The difference between that purchase price and then this lower sales price is the capital loss. You can use these capital losses to offset capital gains. Capital gains are just profits from underlying securities that have appreciated from their underlying share price that you bought them at. Losses offset gains dollar for dollar, effectively reducing taxable income from your investment portfolio. You can also use capital losses to offset ordinary income. Losses in excess of the capital gains can be used to write down ordinary income up to $3,000 per year. So in a year where you have $5,000 in excess capital losses, you can take $3,000 of that $5,000, write down your ordinary income, and then that additional $2,000 is still floating out there. You roll forward to the next year where you can then offset capital gains or use it to reduce taxable income in the following year. So let's just go through an overly simplified example of tax loss harvesting in action. So let's say you sell investment A over here for a $10,000 gain, and you sell investment B over here for a $7,000 loss. You take the net of those two, which would be a $3,000 gain, and that is what you have to record on your tax return for your capital gains. Now, in a scenario where, let's say you still sold investment A for $10,000, but investment B you sold for a $17,000 loss. You net those two together and you have a remaining $7,000 capital loss here. So for the current year, you can take $3,000 of that $7,000 remaining and use it to write down ordinary income. And the remaining $4,000 will then be rolled forward or carried forward to the next year in order to offset capital gains you have next year or reduce your ordinary income by $3,000 again. So what are some of the benefits of tax loss harvesting? First, it's lower taxable income. Offsetting capital gains and reducing ordinary income will reduce the amount of taxes you have to pay in a given year. There's improved portfolio efficiency. Tax loss harvesting allows you to realize losses in underperforming assets and reinvest the proceeds in something that may perform better. There's also the deferment of taxes. By strategically realizing losses, you can delay paying taxes on capital gains, allowing your portfolio to compound more efficiently over time. There's the carry forward benefit. If you have more losses than gains in a given year, like we've already talked about, that excess can be carried forward indefinitely if you're not using it to offset ordinary income in the given year. An important consideration for tax loss harvesting that you need to be aware of is the wash sale rule. The IRS prohibits claiming a capital loss if you repurchase the same or substantially identical security within 30 days before or after the sale. This is known as the wash sale rule. To avoid this, you replace the sold security with a similar but not identical investment. Example of this would be replacing a mutual fund with an ETF that tracks a similar index, or selling Microsoft stock but buying Apple stock. Now, these are in no way, shape, or form recommendations, but I hope you see what it's doing is you're just replacing one security with one that should perform similarly to the one that you just sold, so you don't invoke that wash sale rule. Another thing that you need to be aware of are short-term versus long-term losses. Short-term losses are for assets that are held for less than 1 year, and they use to first offset short-term gains, which are taxed at higher ordinary income rates. Then there's long-term losses, which are losses on any security held for longer than 1 year, and they're used to first offset long-term gains. There is a netting process that if there's short-term losses left over after netting against short-term gains, and you still have long-term gains on your capital gains for the year, they can then offset that. But you just want to be aware of how it's structured, so that way you're getting the maximum benefit in any given year when it comes to the netting process of these capital gains versus capital losses. A third thing you should be aware of is tax bracket and timing. If you're in a lower tax bracket or expect capital gains to be taxed at a higher rate in the future, consider timing your losses to harvest them in a way that will have the most impact when you are in the higher tax bracket. Finally, the last thing you should do when it comes to tax loss harvesting is automating the implementation of tax loss harvesting on your account. It can be very tedious to do this manually. So working with a certified financial planner, you can have them set up an account that does it for you. This lessens the amount of time that you have to track how all your positions are performing and which ones make sense to sell, which ones don't make sense to sell, and just sell the losses when you can sell them and, harvest those losses and use them to then offset gains in the current year or hold for future years to lower gains that you're expecting to have in future years' ordinary income. So the thing with tax loss harvesting that's really beneficial to you is there's many studies that say that having a systematic approach to harvesting losses within your brokerage account can increase portfolio performance by 1% to 2% by eliminating this tax drag. This has the potential to recoup more than what an advisor may even charge you to manage that account altogether. So you're essentially, by automating this process with a certified financial planner, you're probably getting as much value or potentially even more than the fee you're paying that person to do it. It's a pretty good deal. The last way we'll discuss today on ways to lower your taxable income as a high-earning W-2 employee is to strategically pick your brokerage account investments. The first thing you need to do is what I call mine the dividend on the positions inside of your brokerage accounts. Dividends are taxable at current ordinary income tax rates each year. If you receive a qualified dividend, it has a special tax treatment where it's only taxed at the capital gains rates, but it's still going to add money to your baseline taxable income. Investors who earn a lot of money and then receive taxable dividends on top of this only pay more in income tax. Finding securities that don't pay dividends or pay very low dividends can be a strategy to implement to save adding to your tax bill. Typically, these companies are investing their earnings back into their business as opposed to paying them out to shareholders via these dividends. This could lead to high levels of appreciation because of the investment back into the company. Pairing this strategy with tax loss harvesting could help you partially offset or completely offset gains in these types of investments. Another type of investment that you need to be aware of when you're a high W-2 earning employee is municipal bonds. And if you've never heard of municipal bonds, let's just go through some of the basics right now so you have a better understanding. So with a municipal bond, there's always an issuer, which is a government entity issuing the bond to raise funds for public infrastructure or some sort of project or service that they want to run within their jurisdiction. There's the investor, who are people like you and me, and we buy the municipal bond. And essentially what we're doing to that municipality is we're lending them money in exchange for regular interest payments, which is known as the coupon payment, and then repayment of our principal at maturity. And then maturity is just the set term that the bonds have. This might be 5 years, 10 years, 30 years. But it's the amount of time that you're basically going to be investing in this project and receiving these interest payments before your principal's returned to you. Some of the tax benefits of municipal bonds are that they're federal, state, and local tax exempt. So interest earned on most municipal bonds is exempt from federal income tax. And if you purchase a municipal bond issued in your home state, the interest is often exempt from state and local income taxes as well. An example of this is if you live in California and buy a California issued municipal bond, you may avoid both federal and state taxes on the interest payments that you receive annually. So when evaluating a municipal bond to see whether it's a good deal, is you want to look at the taxable equivalent yield. So since municipal bonds offer tax-free interest, their after-tax return can be higher than on taxable investments with seemingly higher yields. So what you want to do is you want to take the taxable equivalent yield, and to find this, you take the tax-free yield or the yield on your municipal bond and you divide it by 1 minus your tax rate. So an example of this would be a municipal bond that's yielding 3% is equivalent to a 4.62% yield on a taxable bond when an investor is in the 35% tax bracket. And how I get that is I take that 3% and I divide it by 1 minus that 35% tax rate, or 0.65%. And when that math comes out, if I have a bond that's taxable and yielding less than 4.62%, to me, I know it's a bad deal because that 3% tax-free yield is essentially going to be a higher return on my investment. There are also some risks that you should talk about with your financial advisor, financial planner with municipal bonds. I'm not going to get too far into detail here, but sticking with highly rated municipal bonds can be an appealing avenue to tax-free return on investments when those other risks are sincerely accounted for within your overall portfolio strategy. So there you have it. That's 5 ways high-earning W-2 employees can maximize their wealth and drive down taxes. This is not an exhaustive list, and there's still other alternatives to consider, especially if a portion of your income is subject to stock options, whether they be incentive stock options or residual stock units. If that's where you find you fall, I would urge you to speak with a certified financial planner, and they can help guide you through the process of liquidating those efficiently. And if you're still watching this video and you want to chat more with someone about your financial picture, please follow the link on the screen here or in the description below, and you can schedule time directly on my calendar. I hope to see you soon.